Let's talk global markets, and Valentijn from ING IM joins us from London to walk us through the global picture. Valentijn, good morning and thank you for joining us. It is expected that Fed tapering would end by 2014. Our markets, especially the emerging markets, are they prepared for this liquidity withdrawal?
Well, prepared is difficult to say. I do think not fully. We've seen, of course, that bond yields have drifted lower a lot in 2014. Somewhat more volatility in recent days, but still I think we could be seeing more of that volatility once the Fed is finished with its tapering action. So that is certainly one of the most important things to monitor, and for the next couple of months something that temporarily could create volatility in markets.
The Fed, Valentijn, has not committed to a fixed timeline on rates. What's your expectation on that front?
Well, we're not too far off from, let's say, the consensus, which is maybe a little bit above what the market is pricing, but we anticipate the Fed to start hiking in the third quarter of next year, but only on a very gradual path as a base case. I do think that if you listen to the latest rumors surrounding the Fed, the risks are tilted to the upside. There seems to be an increased conviction that a bigger part of the fallback, for example, in labor participation, is structural rather than cyclical, which creates somewhat more willingness, I think, to push up rate hikes in the latter part of 2015. So the risks are tilted to the upside for rate hikes, but in the base case we still expect a very moderate hiking path.
Right, so what do you make of quantitative easing announced by Mario Draghi? Is the risk trade on here to stay?
Well, I think we need to realize that the ECB's QE is not the Fed's QE. It's not targeted yet at sovereign bonds and thereby probably not as effective as the Fed in influencing global risk appetite and risk on momentum in markets. It is a positive, but it is more constrained and it faces more political headwinds for further expansion like we saw with the Fed previously. So it helps, it cushions downside risks. It's not really a big push for additional risk on positioning.
Right. Among emerging markets, Indian equities have been standing tall. Do you think valuations are now looking somewhat stretched?
Yeah, I think India, like I said, this came into play obviously late first quarter, early second quarter. By now, it's becoming a bit more stretched. It had a nice run. So I wouldn't say this is the best bet in the EM space. But on the other hand, I think valuations always are only a small part of your investment decision. And once the hopes are in the market and the momentum is good, generally that tends to be more dominant drivers of returns over the next couple of weeks or even months than the valuation metric. So yes, a medium-term concern, not something to be overly worried over in the near term.
In India, which sectors are drawing your maximum attention? Because for the moment, you got rate sensitives, infra, engineering companies, consumer, discretionary. So, what is attracting your attention?
Well, if we talk about sectors, we really look at it at a global basis. It's been one of the most difficult parts this year in terms of overall asset allocation decisions. We've seen an upturn in risky assets this year, and still we didn't really see an outperformance of cyclical sectors. We still think that, especially with this higher probability of Fed hikes coming up, a more cyclical turn in global equity sectors will emerge. So financials, industrials, IT are sectors that we like and prefer over some of the defensive sectors. So that is really where we would put most of our conviction.
Right, and what's your view on the US dollar versus emerging market currencies?
Well, I think there is a lot of momentum currently behind the US dollar. Also they're obviously tied into the Fed, also tied into the stronger cyclical dynamics that we're seeing in the US. So all in all, I think the US dollar will strengthen almost to any currency, most notably in DM space. For EM, if risk on continues to be there, It's more difficult, but so I would say it's more stabilization between EM and US dollar than anything else, where traditionally maybe you would expect EM currencies to outperform the dollar in a growth environment.
What is your view on gold as well as crude?
Well, on gold, we don't have a strong view. We look at it mainly. We're neutral on gold. We look at it mainly, as a potential or as a hedge against potential geopolitical tension, which actually also holds a little bit for crude. Obviously, there isn't enough demand at this point in time. If you look at the technicals in the overall supply-demand situation in the crude market, to really push prices higher, it's quite remarkable, clearly, that crude prices have fallen off in the last 2 months, despite all this geopolitical tension in Ukraine and the Middle East. But still, we think it offers some hedging, characteristics against an acceleration either in Ukraine or in the Middle East of these geopolitical tensions. So we like commodities as an asset class, mainly due to this gold and oil exposure and the fact that provides some insurance against those risk factors.